Hello, welcome to Why Dividend-Rich Canada is About to Deliver, a one-hour programme brought to you by Citywire and Middlefield Canadian Income Investment Trust. My name is Gavin Lumsden, and with me in the studio are the two managers of Middlefield Canadian Income, Dean Orrico and Rob Lauzon. Welcome to Citywire. This is a great time to be talking about Canada. Just this month, Warren Buffett, the legendary US value investor, revealed he was looking at an investment north of the border. This comes at a point when investors are looking at ways to diversify from global markets that have been dominated by US technology giants. Dean and Rob will shortly give a presentation on Canada and their investment trust, which last year won a Citywire Performance Award in the North America equities sector. Dean, Rob, are you ready to begin?
Let's go.
Take it away.
So thanks, Gavin. Really appreciate you having us on today. And we're really here to give an overview of why we think Canada really is ripe for foreign investment, because we think it represents an excellent diversifier for UK investors. As you'll see in the presentation, we have a very similar market to what you have here in the UK in terms of size, but there are some real distinctions. Number one, we are a neighbor to the world's largest economy, arguably the most resilient economy in the US. About 70 to 80% of our exports go there. And secondly, we've got an abundance of natural resources. We're the fifth largest energy player in the world, oil, natural gas, electricity. And I think that really does create a very attractive environment for investors, because I think we're today in a very different environment from where we were, say, a few years ago with respect to the view on fossil fuels and the need for fossil fuels for this energy evolution over the next 2 to 3 decades. So I think that's some of the advantage investors have in this particular product. So as the slide suggests, this is a product that's really focused on dividends. Every company in our portfolio has initiated a dividend and in fact is doing a really good job in growing their dividends. And we're passing that on to investors by way of higher distributions that we pay out on a quarterly basis. Middlefield is an equity income investor. We don't try to be all things to all people, about $2.5 billion in AUM. And we have various strategies, whether they're diversified like this one is, that we're providing to UK investors, or we've got dedicated real estate funds, dedicated healthcare funds, and infrastructure. So my colleague Rob and I are the co-managers of this fund, but Rob's the lead manager for a very similar strategy in Canada that we've been running for 20 plus years. That really is a very similar fund to what we're providing here through Middlefield Canadian Income. So this is right up our alley in terms of what we're doing, and we think we finally now have a tailwind versus a headwind, because we're in an environment now where interest rates and inflation, although they're coming down, will likely be very higher than what you saw in the last 4 or 5 years. We are an active manager, so we are not shy about deviating from a benchmark. And as you'll see in this presentation, we've got specific weightings in things like pipelines, energy producers, and real estate that are higher than our benchmark. And we think that is really well-founded in the value that we're seeing in those types of securities. As I alluded, we're focused on companies that pay a dividend. And when you go through our portfolio, you'll see that virtually every company has a track record of growing their dividends over time. And if you look at this over the long term, companies that grow dividends actually have done a better job in generating better total returns over long periods. And that's clearly where we're focused here on this fund. So that's why we call it as dividends done differently. We're focused on companies that actually grow their dividends. And we run a portfolio that I would describe as being a high conviction strategy. What does that mean? It's not high concentration. High conviction being 30 to 40 companies in our portfolios. Middlefield Canadian Income is exactly that. Average weighting per company of about 3%. And we run various types of risk metrics to ensure that we're not making too big a bet on any one issuer. So here, typically, companies would be no more than 5 or 6% of the portfolio. We'd start actually trimming those names once they get much above that. And at the lower end, you have to have enough conviction in a company to make it at least 1% of a portfolio. We know these management teams intimately. In fact, we just did a lunch here in London a couple of hours ago with the CEO of Enbridge, which has been one of our largest and longest standing holdings. This is a $100 billion market cap energy, pipeline, gas distribution business throughout North America. We know these companies very well by virtue of knowing their management team so well. So that's how we can really, we think, do a good job being a high conviction manager by knowing these companies the way we do. So Middlefield Canadian Income, just by way of a bit of background, it's a North American focused fund that is really trying to deliver high levels and growing levels of income to investors. But we're different from our North American peers because we are the most Canadian focused. We always have to have a minimum 60% focused on Canadian companies. There have been times through the life of this fund, which was launched in 2006, where we've actually been 30%, 35% US. Today, we're less than 10% US because of our conviction and what we think is this turning point on Canadian equities and the types of exposure that we have in this portfolio. We have generated good performance since inception, just shy of 7% per annum. More challenged performance shorter term because of the nature of energy and real estate in particular, which have been out of favor. And again, we think we're at an inflection point where that's starting to turn. In terms of dividends to investors, we are paying 5.3 pence per annum, pay that on a quarterly basis. We've actually grown that dividend in each of the last 2 years. We're running a covered dividend in 2024, so the board will decide later this year whether it's warranted to increase the dividend again, but that's clearly what we're managing to as the manager of the fund. Just a bit of background on myself and my partner Rob. I joined Middlefield in 1996. As Chief Executive Officer today, I oversee the business, but I'm also actively involved in managing this portfolio. I was involved in the launch in 2006. Rob, our Chief Investment Officer, is also involved in managing this fund alongside me. He also manages a number of our diversified and infrastructure strategies for our Canadian clients. So why Canada? And we get this question quite a bit because, in fairness, Canada really has been a laggard, say, versus the US market over the last decade or so. Clearly, we know UK investors are underexposed to Canadian equities. When they think of North America, as I mentioned earlier, they really think of the US. They don't really think of Canada. But we think Canada's got a number of attributes that people want to get exposure to. We're a major resource country, top 5 energy producer globally. We're the largest net exporter of electricity in the world. And we've got a growing population. The total population of Canada is about 40 million people. And in each of the last 3 years, we've brought in about 500,000 new permanent residents, immigration, new permanent residents. So basically more than 1% a year growth in population just from permanent residents. And we've actually got a pretty good points-based immigration program. So you're more likely to get permanent residency in Canada if you've got a certain type of education, if you're of certain working age. And as a result, about 60% come in under the economic class. These are people who actually contribute to the economy right away. And that growth in population really is designed to fill the shortage of labor that we have in our country, but it also results in greater demand for Canadian products and services as well as property. So overall, we think that's been a net benefit. Government is now taking some measures to control the amount of non-permanent residents in coming into Canada, typically international students and temporary foreign workers, which we think is probably warranted given the demand on our infrastructure and housing. So overall, we think it's become a more measured amount of immigration going forward. In terms of the backdrop for Canadian equities, as you can see on the screen here, the Toronto Stock Exchange today trades at about 15 times forward earnings, and compare that to the S&P 500 at about 21 times. We don't have a publicly listed tech sector. We've actually got a lot of tech workers and a lot of tech businesses in Canada, but they're not listed on the Toronto Stock Exchange. So we know the tech sector really is driving the S&P multiple higher. So let's exclude that from the S&P to make it a bit more analogous to Canada. The S&P still trades at about 18.5 times forward earnings ex-tech. So compare that to the 15 times in Canada. We're a full 3 to 4 turns lower. Just shows you the value proposition. And when we think about Canada, we've all experienced this inflation over the past couple of years. Canada took its medicine early. We started raising rates more aggressively and earlier than, say, the US or the UK and Europe. And in fact, you're now starting to see rates come off in Canada. So we just printed CPI in Canada yesterday at 2.7% versus 2.9% the month earlier. And when you exclude the more volatile food and energy, it's sub 2%. So it's basically locking in at least a 25 basis point cut this summer, either in June or July, and now it's becoming more likely that it'll happen in June, so as early as next month. And again, you're not really seeing that anywhere else. The US is maybe September, and based on your CPI here in the UK, that's less likely now as well, relative to where it was a couple of days ago. So we think that's going to unlock a lot of cash that's sitting on the sidelines, that we think has been sitting in relatively risk-free 5 or 6% savings accounts that was otherwise in the market. And we think that now comes into some of the companies that we own, interest-sensitive utilities, interest-sensitive real estate, and even some of the higher-yielding pipelines in our portfolio. So we think this is a net positive, especially when you take that with the type of valuation you're getting in the market. You're not only getting good yields, but we think real upside and re-rating potential over time. So we talk about earnings, and again, it's one thing to say low valuations, but the other side of the coin is that, are they reflective of lower earnings? And in Canada, we're actually seeing an earnings pickup. So as we show on this slide, we're seeing EPS growth expectations of about 15 to 20%. Just over the next 2 years. So the companies that we own, whether they be energy, whether they be our financials, whether they be real estate, which Rob's going to talk about in more detail, the earnings profile is actually really accelerating here. And you're getting that with relatively low valuations. And I think this whole interest rate yield phenomena rolling over is now going to become a catalyst for a re-rating in these types of securities. This is a really interesting slide because it shows the periods where Canada has outperformed global equities. And it typically is during a period where inflation is actually higher than it was during that 2010, 2020 time period. It's also been more successful to be investing in Canadian equities when commodities were on the upswing. And again, I think that's exactly what's happening here as well. I think the view on energy in particular, fossil fuels, has changed. The market was all focused on renewables, and I think that really turned 180 degrees when Russia went into Ukraine, and people realized, and investors realized, that we couldn't rely on cheap gas from Russia anymore, that we needed to find other more secure, stable sources of fossil fuels and natural gas in particular. And we think Canada, given that we're a major supplier of gas with a 300-year reserve life of natural gas, that this is really going to become much more in favor. And Rob will talk about this in more detail in a few minutes. So when we think about why is Canada about to outperform? We're thinking about the inflation rate. We're now seeing inflation coming down, but you're not seeing inflation going back to zero. Correspondingly, interest rates coming down, but you're not going to see interest rates go back to zero anytime soon. So I think that really sets itself up well for what we do in Canada and what we produce in Canada and what we own in this portfolio. So the catalyst that we're seeing here for investors and why they want to own Middlefield Canadian Income, number one, valuations. Number two, fundamentals. Rob will talk about that in more detail. And number three, some of the economic tailwinds, specifically this reduction in inflation and interest rates that are going to be higher for longer, but not as high as they were over the last 18 months or so. And where we're focused in our portfolio is in energy, where we've got 32, 34% of the portfolio split between producers and pipelines. Financials, we have amongst the most stable banking system in the world, and then real estate. So with that, I'll turn it over to Rob.
Thanks, Dean. Let me focus on the three cornerstones of our portfolio currently, which is energy, real estate, and financials. And to Dean's point, valuation is attractive in all three categories. On Canadian energy, the slide that's in front of you on the right-hand side, you see a chart with three lines, but the blue is valuation, the gray is debt, in the red is profitability. So if I didn't have the word energy on it, and I said this is a sector we'd like to invest in, debt's low, valuation's low, return on equity is high, any investor is going to say, yes, give me some allocation to that. But over the last 5 years and even a decade, there's been a bit of a gray cloud over energy, and really all funds flow moved towards clean energy, renewables, wind and solar. And the pendulum has now swung back, as Dean mentioned. Some of the geopolitical events has caused it, but we're taking a more realistic approach to, when I plug my iPhone in, or when I, whether I have an electric car, I want it to work, and I want it to work now. So I need realistic base load, always on power. And that gets you back to fossil fuels, natural gas being the cleanest way to power. And yes, definitely displacing coal worldwide is going to be a great thing for climate. But Canada, and in this portfolio in particular, has multiple ways to invest in natural gas. Not only the gas producers that take natural gas out of the ground are going to be benefiting from higher gas prices and longevity on their business, but the gas pipelines, which move that molecule around North America, we own in the portfolio. They then liquefy it, put it on a ship, and either send it to Europe and the UK from the Gulf of Mexico, or early 2025, so we're less than a year away, that Canada is finally going to have its first LNG facility moving liquefied natural gas from Alberta, Canada, in British Columbia, Canada, to Malaysia, Japan, Korea, to help power their needs. So the nice thing about how we run this fund, MCT, is we want income and growth, and energy provides both of that. So the energy companies that we've been investing in have been consciously paying down their debt, allocating more returns to shareholders, growing their dividend, doing share buybacks. And what really generates money for these companies is obviously the commodity price. $75 to $80 oil is Goldilocks for these companies, where $120 oil, people change their habits, and you might have demand destruction. $30 oil, the Saudis don't want it there, nor is anyone profitable. So we're really in the sweet spot where companies can be profitable. It's not jamming the consumer too much. And it's business as usual. And then on the natural gas side, that's where we're really excited in this portfolio, because again, we're owning the producers, we're owning the gas pipelines and the gas distribution companies that actually bring it to your house, the hospital, the school, where you can plug in and run data centers, you can run your iPhones, you can light your stove, and it's always on. So we're quite excited about our exposure to energy in this portfolio. We're getting diversification within energy, and we're getting exactly what this portfolio wants: a mixture of growth to grow the NAV of the portfolio, as well as dividends. And then second, Canadian real estate. Now, globally, real estate long-term has been a great place to invest. It's an inflation hedge. Typically, there's less supply than a growing population and demand. So real estate prices generally, people's homes have generally gone up over time. But when you look at the sector, the publicly traded REITs, quite an attractive asset class over time, except for the last 2 years, they've been underperformers. And lo and behold, we've had one of the biggest rate increase cycles we've seen, almost from, we had negative rates over here in Europe and the UK. And basically in the States, we've gone from 1% rates to 5% rates over 18 months. So that vicious cycle of rate increases has put all bond proxy equities and real estates, which have embedded leverage into them, into the category of funds outflows, worrying about levels of debt. And then on top of that, the pandemic, people working from home, one category, well, actually two categories, kind of went into the crosshairs of investors of, we don't know what the future is going to be, which is office and shopping malls. Now, our portfolio In Canada, there is no publicly traded shopping malls generally. The pension funds own them all, so we don't invest in them. But in general, the office, we've moved to the sidelines during the pandemic and have not been back to the office category. But there's 5 areas in real estate that the fundamentals have been great all throughout this cloudy period, where companies keep putting up solid numbers and some of them bumping their dividends, but the market has really not cared. And so we are overweight real estate in this portfolio. Our benchmark is 6% real estate exposure. And as Dean mentioned, we're agnostic on benchmarks. We want to go where the puck's going. And we think real estate is about to inflect, given it's got great fundamentals. Rates are coming down in Canada, which should bring fund flows back into the sector. So we're over 20% allocated to REITs in this portfolio. And we're making a cognizant effort here that we think that's going to help drive performance in latter 24, 25, and 26 for the next 2.5 years. And as you can see, there's 5 subcategories here that should benefit from this rotation out of cashable deposit-based instruments that are earning that high rate of interest right now in Canada. Again, as Dean mentioned, bank accounts, you can get 4, 5, 6% by just putting in deposits. But once that Bank of Canada rate starts coming down, and we think the path will be from 5% down to 3.5% by the end of 2025. So that's going to affect savers, and they're going to be switching that back to where they were with that cash 3 years ago into real estate, for example. So industrial REITs are the ones you would see by an airport, warehousing, FedEx terminals, Amazon. And, the great thing about Canada and where we invest is most of our population is in really, 5 major cities, very close to the US border. And when you look at where the major population centers are, they're really islands. Montreal is on an island. Toronto, if anyone's visited, on the south is Lake Ontario. On the north, it's the largest green belt in the developed world where you can't develop any type of real estate. So you're kind of landlocked. So there's limited supply. So as population grows, as urbanization and onshoring, more manufacturing comes to North America, you've got to do that business somewhere. And if there's very little new builds, landlords can charge more rent for industrial properties, for logistics and warehousing. Same with multifamilies. We love the apartments in Canada. As immigration has, brought a couple million people into Canada over the last few years, everyone needs that necessity of a roof over their head. So we own the apartment REITs that, there is rent controls in Canada. You're allowed to raise rates on your rent on a yearly basis with inflation, but raising rates, 3%. But if you've been in a lease for 4 or 5 years, you're still much below market value. So there, as much as the headlines, people complain about the rent costs going up, there's a good cohort of renters in Canada getting very good value on the money that they're spending on their rent. But if they were to leave, whether it's marriage, whether it's moving away for a different university somewhere else, the landlord's able to go to market with that rent. And again, there could be a 20% uplift if they're getting $1,800 a month and they should be getting $2,100. That's an uplift. That's some natural progression on revenue for the REITs that we own and the multifamily. So both industrial and multifamily have that trend as new tenants actually pay more than the old tenant. So it's a good thing. We like to see some turnover in those portfolios. We like retail. We're not all in on shopping malls, as I mentioned, but we like necessity-based retail. If you've got an open-air center that you've got the grocery store that everyone's going to once a week, you've got the Boots or the pharmacy that you go to, they're paying their rents, and the REITs, the landlords are getting inflation protection on those rents. So again, demand is higher than supply for necessity-based retailer and the groceries. So it's another area that, these REITs are trading at a 20% discount to NAV. And that's appropriate if you're in a recession or you've got a lot of headwinds on your business. But all of these REIT subsectors are putting up good fundamentals, and there's no reason that they should be not trading closer to NAV, except for the narrative and the interest rates. So once that starts to come off the boil over the next 18 months, you've got a natural movement towards net asset value for these companies. We also own data centers from time to time in this portfolio, specialized REITs, and even on the healthcare side, similar to apartments, retirement homes are getting occupancy back to pre-pandemic levels. So there's earnings growth that we're seeing with the aging population in Canada for our retirement homes. So a real overweight consciously by us on real estate, and I think investors are going to see the fruition as our thesis plays out over the next couple of years. Finally, on financials, really Canada offers stable banks and life insurance companies, and why we really like them currently. Yes, they've always, they're highly regulated, so they might not grow as quick as other financials around the world, but what you find is you typically don't have problems in Canadian financials. Great financial crisis, we didn't have dividend cuts, we didn't have any bankruptcies. The regional bank crisis in the United States a couple years ago, we were unscathed there. We haven't cut dividends since World War II for our banks. And they're attractively valued. They're trading about 10 or 15% below where they typically trade. And again, we're on an inflection point on earnings in Canada where the banks, which also own wealth management business, equity capital markets business, debt businesses, and that's alongside their normal lending business. As rates come down, stock markets are near all-time highs. There's going to be more IPOs. There's going to be more M&A that they're earning fees on. And when rates start to come down in Canada, there's going to be less competition for deposits. So finally, you're going to have a yield curve for the banks that helps them make a lot of money, where their net interest margins will go up, where you'll have an upward sloping yield curve, where they'll finally paying less on deposits than they are on mortgages, and they'll be able to earn a pretty interesting margin expansion there. So we like the financials as a cornerstone of this portfolio. The life insurance companies are becoming more profitable. And with our Canadian life cos and banks, we're getting some indirect diversification. Some of our favorite banks, the Royal Bank, Bank of Montreal, have done acquisitions in the United States. Manulife is big in Japan, Hong Kong. So they're doing businesses in other areas of the world to give us some inherent diversification, even though we're still collecting their growing Canadian dividend. So finally, just in summary for your viewers, we are sitting in front of you now with probably the best entry point into Canadian dividend income that we've seen. And it's really because we think we are, months or weeks away from the first, G7 nation to start cutting interest rates. And once they start to cut, the cycle will begin. And we're not going back, as we mentioned, to where we were, where global rates were negative or zero, but probably halfway back down to the old normal. When 20 years ago and 25 years ago, when Dean and I entered Middlefield, the 10-year bond was 3.5%, overnight rates were 2.5%, 3%. That's the old normal. And our companies, many of which we still own from 20 years ago, were growing their dividend, growing their business. So we're going back to the old normal environment. So we've got a positive economic outlook for Canada with rates coming down, solid company fundamentals. Dean and I were talking on the plane over and just discussing, we don't have any problems in our portfolio. There's not one company that we're, on a view of, well, I got 3 things to worry about, 3 things that I really like. We are really excited about every company we have in the portfolio. The valuations are cheaper than we've seen in the past, so you've got a good entry point. And again, most of the companies we've talked to, they've all been on earnings calls recently, intend to continue what's been in their DNA and our DNA of growing their dividend, and that's what we do for our investors here in MCT, is provide income first and foremost. 5% dividend yield is approximately what we're yielding now in the market, and hopefully over time we can continue to grow that dividend and pass on capital appreciation within the NAV of the portfolio as well. So with that, that's
Rob,
hopefully the story for you.
Fantastic, Rob, Dean, great overview. Thanks very much. But yeah, Dean, listen, let's go back to Warren Buffett. He's got Berkshire Hathaway, his company's got $180 billion cash pile, I was reading, and he's looking at putting some of it in Canada. How much of an endorsement of what you're talking about is represented in that report?
Well, I think it's not surprising, to be honest, because when you think about Berkshire Hathaway and the types of investments it's made over time, it's a value investor. And as we've just showed on the slides, I think you're seeing exceptional value in Canada. Warren made it clear in his commentary at the AGM a few weeks ago that they understand the Canadian market. They recognize it's a good place to do business. So when you think about some of the things Canada does very well, whether it's energy infrastructure, I mentioned Enbridge earlier, that's an ideal type of opportunity for a company like Berkshire Hathaway because it's undervalued, it's well capitalized, it's well run. So when you see Berkshire basically selling some positions like Apple and recycling into other areas, we think Canada's a natural place. And it's probably not a coincidence that the next CEO of Berkshire Hathaway, a fellow by the name of Greg Abel, is Canadian, actually from Alberta. So he understands the energy business very well. So I wouldn't be surprised, although time will tell who it is.
They already own an energy business in Canada. I was reading Berkshire Hathaway, Canadian Energy or something.
That's correct.
Yeah.
So they've already got some exposure, but they're clearly looking at furthering that exposure, just given the type of opportunity you're seeing in the Canadian market today.
And you think there could be more smart money to follow. It's a smart thing to do. I'm really struck, actually, by the comparisons between the Canadian market you're describing and the UK. Maybe slightly old model, old world, lots of financials and banks and energy companies.
There is, for sure. And
have you suffered the same kind of outflows, investors investing globally, kind of shying away from the domestic market?
Well,
has that been a trend in Canada?
Our pension funds, over the last 20 years have clearly started to look at infrastructure investments outside of Canada because that's where the opportunities are. So they're looking to get outside of just normal Canadian public equities and move outside of Canada. So that's certainly been a pattern. And again, when you think about what's been happening in the US market with technology and growth, again, another reason to actually look outside of Canada. But I think that tide is starting to turn the other way. So you're seeing some comments out of Berkshire Hathaway. Just in the past few months, you've seen Blackstone make a major investment, bought one of our Canadian residential REITs, an area that we really like, at $4 billion. It announced that acquisition, paid a 30% premium to the previous day's trading price. TPG, another major private equity player, just put $1.5 billion into Canadian industrial properties in and around the GTA. So short answer is yes, you're starting to see the smart money come into the market. And as we've liked to say, they're not waiting for the all clear. They realize that rates are moving in the right direction, valuations are there, so they're starting to take action.
Okay, so you're sounding pretty confident that the style headwinds that have been running against your more cyclical and value type style portfolio should recede as interest rates coming down. But aren't interest rate cuts also good for growth investors as well?
They are. So clearly, when you think about growth stocks, they're typically long duration equities. And when rates come down, that makes those more valuable. But I think it's important to take a step back and say, okay, there's money that's moved onto the sidelines. So Rob showed a chart there that showed, all this cash sitting on the sidelines. In the US, there's $6 trillion in money market funds. I think for investors who've been looking for growth stocks, they've been buying growth stocks. You're seeing what's happening in the Nvidias of the world. But investors who were looking for income, i.e. equity income, basically been sitting in 5%, cash savings accounts. That's the money we think comes back into the market. It's already been in growth stocks, and I think that's what migrates into the types of names that we own in this portfolio.
Okay. I was intrigued whether obviously it's an equity income portfolio, but does the portfolio have any direct or indirect artificial intelligence plays? Because in your annual report, you cited that one upside for cheap utilities was a higher demand for electricity from AI and decarbonisation.
Yeah, we've got one direct actually two direct and a handful of indirect. So the directs would be Brookfield Infrastructure Partners. It's a diversified publicly traded entity that has direct investment in data centers. Their growth is definitely building out more data centers driven by the AI demand. Earlier this year, we did add a position in Alphabet, in Google. One, we surmised that they were close to following Meta's lead in initiating a dividend, which they did last month. So that's important for the fund, and obviously that'll be it's a small dividend, but it's going to be a growing dividend. But Google basically is the internet. They are the infrastructure of the internet, and with that, they have developed such a large database from us. Well, you can follow me, listen to me, watch me, but with all of that data, they're able, with all of their engineers, to create quite a valuable AI platform, which they're just starting to roll out. And we remember a few weeks ago or a month ago when they started rolling out, there were some hiccups. That pullback in the stock is what got us into it. But indirect ways is really the gas distribution, because powering data centers, you need them to be always on. And if you did a simple Google search, you're using X amount of power. If you do that same search through ChatGPT using AI and using the data centers, you're using 10 times the amount of power. So the pull and the demand for power because of AI is going to grow. There's lots of debate whether it's 1% or 3% a year of increased power demand, and the grid's pretty big in the United States. So we own, how do you get baseload power? Where it's hard to build more nuclear, it takes 12 years to build a new nuclear plant. But you can bring on gas, new gas, in 2 to 3 years, and there's lots of current gas out there providing grid. So we own, as we mentioned, gas producers. We own the gas pipelines that'll be moving around more volume, and the gas utilities in Enbridge and AltaGas, which actually connect to the data centers, the schools, the hospitals, the homes, and then we own a renewable company that builds out the wind and solar, because these data centers and AI like to have a mixture of base load, so they're always on, and then also 10 or 15% of the power when it's sunny, when it's windy, powered by zero emissions. So it's a way we've got some exposure to it, and there's been a lot of hype on that sector in the last two months or so, and we're starting to see some of these stocks reflect a bit higher valuation because of the growth potential.
That's great. Now, you've mentioned Enbridge, you've mentioned pipelines a couple of times, but that's really a sector that we don't have in the UK. Would you like to say a bit more about how pipelines, how does their business work, how do they get paid?
Yeah, they're really a utility, really like a railroad or a tolling agreement. So they don't want to take the risk of deciding where to put something in the ground to pull out gas or oil, try to market it. What they will do is say, once they'll go and contract with the most highest investment grade producers of the commodity to get a contract, and hopefully a 10-year contract, to then move that product to the end consumer. And an integrated pipeline will actually have, as AltaGas and Enbridge have, is the end distribution. Some of the pipelines then sell to a refinery, for example. So essentially, you're trying to create exposure to energy, to volumes, without the price risk and without the volatility. So it's really kind of like moving goods along a line, like a railroad. You're moving hydrocarbons, but you're insulating the volatility and locking in a 10% rate of return. So, you're not going to double your money every year in these, but if you put them in a drawer and forget about them every 7 years, you should be able to double your money, because they have ROEs of about 10% a year, and they all pay high levels of dividends back to shareholders.
And at a high level. So what is Enbridge? As Rob described it, it basically is moving hydrocarbons throughout North America. So it represents 25% of the moving of liquids or oil from Canada to the U.S. 25% of the U.S. oil production is actually moving through Enbridge's pipelines. 20% of natural gas consumed in the U.S. is moving through Enbridge's pipelines. It actually provides natural gas to about 4 million Canadian homes and soon to be 3 million U.S. homes. And we also talked about LNG. About 15% of the natural gas that's going into the LNG facilities on the Gulf of Mexico is actually moving through Enbridge pipelines. So it's an integral infrastructure play that we really can't live without. Its assets are really irreplaceable. That's why we love the business.
Impressive. Can I ask you a couple of questions, more technical questions about the trust, just for the benefit of people who might be doing some more research into you afterwards? Can you clarify what benchmark you use to measure your performance? Because I think there appears to have been a change over the years, and the fact sheet refers to the TSX Composite and also the benchmark.
So we have the broader TSX Composite in Canada, which really is representative of the whole market. And then there's also a more nuanced high dividend index in Canada that really represents the top 75 yielding stocks in the Canadian market. So we really look at both of those as our benchmark, generally speaking. And in fact, we were involved with S&P to actually create that high dividend index. It's market cap weighted. So as we mentioned, when you think about the high dividend index in Canada, because the banks are so large, they're a disproportionate share of that index, whereas REITs, which we really like in this market, are only 5 or 6% of that index.
Okay. And in terms of currency, the fund used to be hedged up to 2011, a long time ago now, but it doesn't do that. But just can you comment on what that change was about and give some historical context on the pound versus the Canadian dollar?
Sure. So we used to have, you're right, when we launched the fund in 2006, we actually had a structure that embedded a currency hedge in it. And that structure was unwound for tax reasons in 2011, 2012, after which we actually went unhedged. On an ongoing basis, Rob and I meet with our investors at least twice a year and some of our key investors, and we ask them, do you prefer to have it hedged or unhedged? And they actually, on balance, prefer an unhedged exposure. They say, if we're going to buy your fund, we want exposure to Canada, we want exposure to the currency. And then when you look at, Gavin, to the second part of your question, how has CAD done versus GBP? We're effectively right in the long-term range at about kind of 1.7, 1.72 times. So we're really quite there. So at the end of the day, we're finding very few investors who are preferring a hedge. We'll basically respond to the needs of investors, but right now they're saying we prefer it unhedged.
Okay. And can you explain your approach to gearing, the borrowing that investment companies like yourselves can use to kind of enhance the amount you're investing in the stock market? It was cut to 13.5% at the end of last year from an average of 19.5%. And then it's back up again, I think, at 21.5. Seems quite punchy. Is that an expression of your confidence?
Yeah, that's really a good way of putting it. You can look at our gearing and the amount of it based on our bullishness in the market, and we'll toggle from 0.5% gearing to typically 20% at the high end. And as you noted, we're close to 20% currently, which shows how bullish we are on our stocks in the portfolio. We want pretty much maximum exposure to what we see coming here for the fund. So it's and another kind of tailwind we'll get is we borrow short, typically 30-day paper. So every 30 days it rolls over. So as rates start to come down in June, hopefully July, maybe we'll get one more. So 3 times this year, our borrowing costs are going to come down, and we're not locking in that rate because we think it's coming down. So that's going to be a small tailwind on our income statement, free up cash for potential distributions, invest back into the market. So kind of 2 tailwinds. One, we like the general market. We're okay being levered up right now, and we actually find it as from an income cash in, cash out should finally provide a tailwind on the fund.
Okay, great. Let's turn to some questions from the viewers. The prospect of falling interest rates should help those real estate investment trusts. You've touched on this a bit already, but Tim Vernon is interested to know a bit more about the M&A and the bids that might be going on in that sector in Canada, because as he points out, in the UK, a number of REITs are considering or entering wind down. Given Middlefield Canadians holding in property, can you talk about corporate activities for the Canadian REITs? Sure.
Dean, do you want to take this?
Yeah. So we've now, in the last 6 months, started to see some takeover activity and some significant investments in our Canadian REITs. And if you really go back over the last 5 years, it's been a bit bittersweet because Blackstone, which has deep pockets, one of the world's largest private investors of real estate, has actually taken out at least 3 of our REITs over that time period. And then in January of this year, they just acquired Tricon Residential, which is a multifamily REIT, and as well as single-family homes in the U.S., but domiciled in Canada with a lot of Canadian assets. That acquisition was at about $3.5 billion, and as I alluded earlier, the price paid by Blackstone was almost a 30% premium to the previous day's trading price. And just about a month before that, TPG, a large private equity player, made about $1.3 billion investment into industrial properties in the Greater Toronto market. And I think this is relevant, Gavin, because when we look at NAVs and we say, well, they're trading at a 15 or 20% discount to NAV, I think the question a good investor should be asking is say, well, is that NAV real?
Is that valuation right?
Is it right? Or is the market telling you something? And what we've seen through these private market transactions, and there have been other that have been a little smaller than the Blackstone and TPG deals, in fact, it's validating the NAVs being reported by the REITs that we own. So I think that's not only healthy from a NAV perspective, it's also healthy from a perspective of recycling capital. M&A activity is always healthy because it validates, prices, validates valuations, but it also provides more capital to go in to the market. So for example, we were a big investor in Tricon Residential. It's allowed us to recycle capital into other names that we like, specifically in the multifamily space.
Okay, brilliant. Thank you, Dean. Andrew Moffat wants to ask about your income profile generation proposition. You offer a 5% yield, but he's asked, please tell us about your debt profile and the coupons, and what are your dividend reserves, and to what degree is the dividend covered by revenues? Quite a lot there. Have you got all that?
Yeah, so we don't have any dividend reserves, but over the last few years, we've actually been running a covered dividend. In fact, that's resulted in the board deciding to actually bump the dividend. So we bumped it by 0.1p in January of 23. We bumped it by another 0.1p to a total of 5.3p per annum in January of 24. We're running a covered dividend again this year. We're probably at about somewhere in that 105 to 112% dividend coverage. And that's in the face of higher interest rates. So we've got some gearing in the portfolio, as Rob discussed. So we're even able to have a covered dividend in the face of higher interest rates. So if this plays out the way we think it will, and that rates are starting to come down, that's going to provide even more dividend coverage over time. So I think the board will certainly take that into consideration when it reviews what to do with the dividend at the end of this year.
Okay, great. And Justin Clark is wondering, you're a large company investor, public equities, but Justin Clark's asking if you have significant exposure to illiquid assets. So I guess that could be either smaller companies or unquoted companies.
Yeah, I'll make a couple comments. Rob can add here, but we at Middlefield, we're definitely, as we say, a high conviction manager, but we're focused on quality. And what usually goes hand in hand with quality is liquidity. So we've got various risk tools that we implement across all of our strategies, including MCT, one of which is determining, how quickly can we liquidate a security in the portfolio if for whatever reason there's an impairment and we decide we want to sell it. And the most recent, and we do this on a weekly basis, the most recent measure basically says that, if we represented 30% of the average daily trading volume of a particular stock, it would take us a maximum of 2 days to liquidate the most illiquid position in the portfolio. Most of them can be done, certainly within an hour.
So the answer is no, not many illiquids. Great. We haven't talked about politics yet, and interesting to hear that you've got this skilled worker immigration going on, and it's positive for real estate. But is there any political impact, any downside, in terms of populism or nationalism?
Yeah, in my view, you can get me going on this, but we're really not seeing any populism or nationalism in Canada. We're quite different than the U.S. in that we're a very multicultural society. Canada was basically built on immigrants. So from that perspective, very similar to the U.S., but the U.S. is certainly more of a melting pot, whereas we actually encourage, this multiculturalism. And from that perspective, there's really been no issues. Having said that, when you're talking about 500,000 new permanent residents in any year, and then on top of that, you're seeing non-permanent residents come in as well, temporary foreign workers or international students, that's actually creating a bit of a challenge to our infrastructure, to our healthcare services. So what the federal government has done more recently is actually they're bringing that non-permanent residents quota down. They're keeping the 500,000 in permanent residences. So the question is, well, what impact is that going to have on our portfolio? So people think, well, the apartment REITs may be impacted by that. There might be less demand. Let me square that for people in that we've got a shortage of housing in Canada. The last estimate by the federal government was that we need to build somewhere between 3 and 4 million new homes between now and 2030 just to bring supply in balance with demand, i.e. to restore affordability. The reality is, Gavin, we produce at most 250,000 homes a year. This year we'll produce closer to 200,000 homes a year. So the thought of restoring affordability, bringing supply and demand into balance over the next 6 years is not going to happen. So even though we're going to see a reduction in non-permanent residents, the reality is the apartment REITs continue to be really well positioned.
Okay, and sticking with politics, but Canada's got an election next year. What's going on and how are you preparing for it?
Rob?
Yeah, it looks like the polls right now, the current government's been in power for almost 9 years. Sometimes longevity is what gets you out of power, or just people want change, and we've seen that with other regimes across the world. But I think because of what's happened on inflation the last couple of years, consumers, voters are just looking for change and maybe some more pro-business policy. So right now, the Conservatives have a 20-point lead in the polls. So a very good chance we have a change. We've had liberal governments, we've had conservative governments for the last 20-something years that I've been managing money, and stocks have done well with both parties. We suspect pro-business policies will continue to, especially for our natural resource side of the economy, and getting those products, whether it's fertilizer, whether it's uranium, whether it's natural gas, whether it's oil, electricity, getting it, export it to earn proper taxation, proper revenues for the good of the country. So, where it stands now, it looks like a change of government, but a lot can happen in the next 16 months or so. The next election's probably not to the fall of 25.
Okay, it's some way off. Close to hand, of course, is the US presidential election. So how are you viewing the Biden versus Trump rerun?
Well, it is interesting, and I think at this point we're probably too early to say in terms of which way it's going to go. But it is a binary decision, at least as we sit here today, assuming both of these guys survive until the election. Clearly when Trump was president from 2016 to 2020, I think you can look back on that period and say that there were probably a lot of good policy measures put in place and no war started during that period. The other side of it with Trump is that clearly he's a very unpredictable person. And then with respect to Biden, the reality is Canada has continued to operate, fairly well over time. One can argue that Biden is less business friendly, but the reality is our oil and gas out of Canada, our commodities coming out of Canada have flowed into the U.S. market basically on an unimpeded basis during the Biden administration. So on balance, I think we're pretty indifferent. Is it possible that if Trump wins, could he open up maybe some tariffs with Canada or whatever the case may be? The reality is we already went through a pretty painful negotiation of our free trade agreement between the U.S., Canada, and Mexico during the first Trump administration. So hopefully that's now behind us and settled, so we don't have to revisit that. Okay.
And can we talk a bit more about the two major infrastructure projects that you've flagged up in your annual report? What is the significance of the Trans Mountain Pipeline and LNG Canada? I think, Rob, you might have referred to that earlier on, but do you want to say a bit more?
So Trans Mountain Pipeline, there's an expansion that just finished. Very high cost overruns to get it finished, delays of many years. In fact, the government actually had to buy it and control it, and maybe that's why it caused a lot of cost overruns. But the point is, it's now finished, and sometime in the next few weeks, we're going to get our first oil onto ships from the expansion part of this pipeline over to refineries in Asia. And essentially what Canada produces about 4 million barrels a day of oil. The current pipeline is about 300,000 barrels a day. The expansion portion is about 600,000. So the total size of this pipeline now is about 900,000 barrels a day. So almost 20-25% of our overall production. It's going west from where we produce oil in Alberta to the west coast of Canada. So that's the main implication is, one, higher revenues for the country because they make royalties on oil sold. But two, it should narrow the differential that Canadian producers receive for their oil versus global markets. And that's all transportation costs. And the further you're away from the burn tip and the end user, the lower price you're going to get. So in Texas, WTI pricing, let's say, is $80. Over the years, our differential, our discount, has been $15 to $20. So our producers have typically got in that environment, $60 to $65 US for their barrels. The discount is now $10. So the discount is tightened because we're not sending all of our oil down to Texas anymore in the Gulf of Mexico. We've got a new outlet. So more egress, more places to send our oil. We've got more competition for it. So pricing is actually higher for our oil producers. So that's a good thing. On the natural gas side, same thing. We will access global markets. So we're going to access global pricing with our natural gas. Currently, we're landlocked in North America, furthest from the burn tip, so we're getting the worst prices in North America for our vast natural gas. That's about to change. LNG Canada is going to be shipping 2 billion cubic feet a day off the west coast of Canada, again to Asia, starting in about 8 months. And that should get us global pricing. So that should double the price that we're currently getting for our producers. So again, very strong for the Canadian economy, for revenue, but also for the producers and some of the infrastructure, because they just get paid on every molecule that flows by. So there's going to be more oil and gas moving around Canada. So great for our pipelines and great for our producers of those two commodities.
It sounds like it'll be worth the wait. Okay, well, listen, we're nearly running out of time, but one more last question from the audience. Straightforward one, I think. What is the cost of investing in your trust? But I'm going to add another one on. You mentioned discounts, different kind of discounts. But what do you do about controlling the discount on your own share price?
So the cost is about 1.25, 1.3% or so. Our management fee is 70 basis points, and then there's some additional costs above that. And clearly, as we grow the size of the fund, that cost comes down because there's a significant fixed cost component to that. And in terms of controlling the discount, the board is always reviewing the need for a buyback. We're a smaller trust, so as a result, when you start buying back stock, it could, in fact, really exacerbate the problem because it actually shrinks the size, even though it's accretive because you're buying it back at a discount. So really, in response to some of those needs, I've been personally buying more stock. I've now bought...
Good. We always like to ask if managers got skin in the game.
I do have skin in the game, and in fact, even in the last 12 months, I've bought an additional 120,000 shares. The investment manager, Middlefield Limited, has bought an additional 60 or 70,000 shares as well. So we do see it as great value, and we're putting our own money to work.
Right, because the shares are about 13% below the net asset value. So that's a good buying opportunity.
It really is.
Okay, well, let's leave it there, gentlemen. Thanks very much for your time. It's been very interesting. But in the meantime, that's it for today. And until next time, keep a lookout for further programs from us. But until next time, goodbye and happy investing.